First, do you feel that?
What was that?
Trade tremors sweeping across Wall Street as President Trump says that he will not meet with President Xi ahead of the March 1st trade deadline. The Dow sinking nearly 400 points at the lows, the Nasdaq getting hit the hardest, falling back into a correction. And this as the S&P battles against a key level, the 200-day moving average. So is this a sign the trade deal is not a done deal? Is there more trouble ahead?
Yeah, well, listen, I've been thinking the market's going to sell off now for the last 3 weeks or so, incorrectly. But I'll say this, 2710 in the S&P, Steve can speak it. That's a big level for me. Yes, we traded through it to the upside by a couple handles. Not a big deal. We're below it now. I think we roll over here. In terms of the trade deal, again, I think everybody seems to think when President Trump is ready to make a deal, there's a deal to be made. I'm not certain that's the case. Again, I think the Chinese have far more resolve, and we'll see what happens. But to answer your question, yes, I think there's more pain ahead.
I agree with Guy. I think there's more pain ahead. And like Guy, I've been calling for a retracement for much of the time. So I've been surprised for about the last 6%. I thought that we would rally 10% off that drastic low that we saw before Christmas. But right now, it still is about China. But I think they want to make a deal. It's just not going to come in time for the market.
Well, look, we heard about Europe. We've heard from all the people that are looking at positioning in the market. Guy, you're a Billy Joel fan.
Huge.
He's got a terrible song called I Don't Know Why I Go to Extremes. And that's exactly what this market has been. Basically, we were so oversold by the end of December, and we were so overbought 2 days ago. It's not surprising that we pull back. The good news, folks, is you had Fed Kaplan out today basically saying we're going to let this economy run as hot as we need to. He basically was pouring any water on any type of a hawkish Fed anytime soon. In other words, good news for equities. I still think the Fed is the most important dynamic. It's just amazing to me we wake up today and we worry about Europe when I think we should have been worried about Europe for the last 2 years.
It's funny because when the trade headlines cross, that's when we saw the market really react. But at the same time, we saw the reaction. You pointed this on the conference call in areas that do not have any exposure to China.
Yeah.
This just seemed like a risk-off kind of move entirely, not just the notion that, these stocks are most exposed to China, and therefore we're selling those stocks.
Yeah, I mean, we were talking a little bit about some of the MAGA names that don't really have a ton of exposure. Microsoft, it's Microsoft, Apple, Google, Amazon. But here's the thing. It's really the Google and the Amazon, and I think what's really important is that there were things not to like in their quarters in the last week, but they didn't trade so badly. Today, when the market didn't have a great feel to it, they went down 3% in a straight line. And that just kind of tells you that this move off the bottom was pretty extreme. There was a lot of actually bad news that was discounted in. I'll just mention this. This is the thing, and we've been talking about it on the desk for a couple weeks now. There's been stuff that's just kind of overshooting the upside, much like they overshot to the downside last month. But the stalling out in the bank stocks since they reported earnings, look at what crude oil has done over the last couple weeks. It's stalled out at a level where it broke down in late November. And then I got to tell you, I just don't like the 10-year Treasury yield at 2.66. It looks horrible. It looks to me like it's got another leg lower. And when I see those very economically cyclical, exposed the banks and oil, and then you see that, I just don't like it.
So just think about what you said there. So the inverted yield curve that everyone was worried about, you're not getting a steepening. At least now you're not getting a steepening. Not good for the banks. What about the dollar if we have a trade deal? It's going to rally. I would assume it would rally. That's bad for oil. So you have a lot of these correlations that are on and off again. And it seems to me that the market wants to go lower, but everyone is so underbought because of that sell-off that we had. You had a short covering rally.
I just think all we're doing is we're correcting from overbought conditions. I'm not telling you that the world's a better place. I think, first of all, the differential. Okay, yeah, an oversold place. The bottom line here is, first of all, as it relates to banks, 2s10s, yield curve steepness or lack thereof is something we've basically been in the same place since July. Okay, banks are not trading on the yield curve right now. In terms of oil, I actually would argue that oil is trading pretty well, and I think it traded hard down to, if you look at Brent or WTI, whichever you follow, this level on crude to me, somewhere around 61, 62, I think is decent. I think there's support for oil. I think energy stocks, which are basically the most shorted they've ever been in their history, look kind of interesting here. So, I think there's two sides to this. To me, I just think while the rest of the world, differentials to the U.S. don't look great, the U.S. is not going into recession tomorrow. It's very clear to me, despite the fact that Germany is telling you they may be. And I think that's what the market did today.
So is the bottom line that the U.S. is the best place to be, or is there a notion in the market? And you are not here for this, so it'll be interesting to get your fresh take on what Joe Zeidel told us yesterday, and that is we're seeing central banks around the world move towards easing in a much more sizable way, especially as growth forecasts have come down. Steve Leisman had a great chart to show this earlier today, basically where all the central banks stand and where they have changed in terms of their stance. Even just recently, the RBA, Reserve Bank of Australia, just changed. Yep. India just changed. Eurozone growth outlook got revised lower this morning. Maybe that's a good thing.
For markets,
easy money is a good thing.
Great Rodney Dangerfield movie, too, by the way.
It's a lousy money. Actually, there are very few good Rodney Dangerfield movies, if you really want to know the truth.
The fact that we're spending this much time on Rodney Dangerfield movies is really disturbing.
He gets no respect.
Back to central banks easing around the world.
That has been a catalyst for markets to go higher, without question. By the way, and not to get off track, but I think that's one of the reasons we should still be doing what we're doing. We should still be moving forward because as everybody weakens their currency, we have an opportunity to strengthen our foundation and to strengthen our currency. I digress for a second. I think at a certain point, you're going to hit a point of minimum marginal returns in terms of central bank activity. I think we're pretty close now. You can only go to that well so many times before the market starts to call you, and I think we're just about there.
But so let's go back to mega cap tech, the ones that do have international exposure.
No, so weird.
Mega cap, not MAGA cap.
But this has been brought up twice.
You said MAGA cap.
A strengthening dollar versus also a global growth that's weakening is actually going to be very bad for mega cap tech. It's just
where do you think the dollar's going, though, Dan? I mean, how does the dollar run away from us?
Really well, hasn't it, for a while?
I think the dollar also has basically gone 1.5% in the last 5 sessions after also doing nothing for the last 6 months.
But just on a relative basis. The rate differential. You look at all the negative yields, all the sovereign debt.
The Fed's on hold. People are saying the Fed's going to cut. You think the dollar's going to rally into this? There's no way.
It could rally. It could rally just in relationship to the rest.
Of the other currencies.
It could rally just in the relationship to the rest of the world. And by the way, I think it's a big mistake. It's a big mistake to count the Fed out for 2019. I think that the market has overestimated the dovishness in the Fed. They're still performing QT, and there's still a chance that they hike.
So then how is growth so bad if we're underestimating the Fed's resolve to actually chase what could be inflationary dynamics in the economy, which seems to be growing? In other words, you can't have it both ways. If the Fed is in play, the economy is if anything, overheating, right?
The Fed is still performing QT, though. So they're still removing liquidity from the market by the tune of $400 billion per year.
Well,
they're still at it.
I don't know that people are thinking the Fed's going to do that. And if anything, part of the last rally for the market, probably the last 200 S&P points, was a view that Powell was also no longer robotic on $50 billion coming off the balance sheet. Look, I think a Fed in neutral, and this goes back to Jay-Z, Mr. Zeidel, and what Melissa brought up about global central banks. I think tightening out of central banks' arsenal right now in the short run means markets have a very good backstop.
Are you laughing?
I think
you've been off the show for a while. Welcome back, first of all.
I've been all over the place.
I know.
And I watch you on airplanes and stuff.
You're not watching anything.
A lot of fast money fans out there across the United States. Yes, Mel, you're going to ask me a question. What do I think about?
You look like you had a comment in you.
No, my comment is, when we come to an impasse at this point of the show, usually it's good to bring somebody in that can sort of bridge that divide. That can sort of cut through all the nonsense. A guy like Tony Dwyer would be perfect tonight.
And he might be able to really bridge both sides by the introduction that you gave him before.
It might be interesting to also have a guest who is calling for new highs in 2019 because we're a little bit skeptical here on the desk in general.
It's refreshing.